refreshing water. Thank you for the introductions. What an amazing panel we've got here today. I'd like to always kick off every panel that I moderate with a little synopsis on the topic, specifically in terms of its importance and some context, and then we'll obviously dive in with some amazing questions with the amazing speakers. So let me just kick it off a little bit here. Today we stand at a pivotal moment where finance is no longer just about returns, it's about resilience, responsibility, and redefining growth. Green finance has evolved from niche products into mainstream strategies shaping capital flows, corporate behavior, and national priorities. Yet the global economy is shifting. Climate risks, regulatory pressures, and investor expectations are converging to demand new models of accountability and innovation. Our panel brings together most of this in a really insightful way from a banking perspective, insurance perspective, and also from a market insight and intelligence perspective. As we look at a lot of these challenges, we're going to examine how financial institutions can catalyze systemic change, balance risk with reward, which is a really important topic we had off stage, and chart some pathways towards a greener, more inclusive global economy. So on that front, I'm going to kick off, and I'm going to kick off to my left because Suzan, you're obviously here representing, I guess, the banking sector specifically. You know, you're an advocate and a voice in sustainable finance in the banking sector. How do you see the role of banks evolving from finance projects to actively shaping sort of national sustainability agendas?
Thank you very much for the introduction. I believe now that the role of banks is evolving profoundly, and we can see the future of finance where this unfolds on different interconnected levels. So we are moving from passive financiers to actually shaping national agendas and being partners with whether other banks or ministries or other stakeholders to shape where the economy is going. On the banking level, we can see that this evolution unfolding on different interconnected levels. The first is the strategic alignment with national goals. Banks use their balance sheets and putting sustainability at the core of their business strategies and setting net zero targets and sustainability pledges. They are using their balance sheets to support the government in achieving their NDCs under Paris Climate. The second thing is that we are redefining risk and we are setting market standards by just not solely depending on the creditworthiness of the clients anymore, and we're by embedding ESG and climate risk in our assessments and credit decisions and stress testing. We are transforming the way the businesses are being led, business models, whether of banks or of businesses. We are setting the standards for ESG and climate risk are a fundamental component of risk pricing and capital allocation. Also by aligning with other international institutions like EBRD or IFC or Green for Growth Fund or others, we co-create standards by aggregating project pipelines and putting certain requirements for the projects that are being financed. We are not only doing that, but we are also not gatekeepers anymore. We are acting as advisors, as conveners, as policy partners. And at Banque Misr, for example, in certain industries like construction, we are engaging with our customers. We just don't reject and approve projects, but we sit with our clients, we engage with them under the UN principles of responsible banking. We explain to them and raise their awareness on sustainability issues, how to create, what global markets expect, what local requirements are there, and how they can transition in a smooth way and have a credible pathway for low carbon. Also, we are redefining product innovation, specifically designing products for the green finance, moving to sustainability. This includes sustainability-linked loans, blended finance, and other instruments. Also, the final thing, I think that the data disclosures that are set by central banks, like the Central Bank of Egypt, we report periodically on our sustainable finance portfolios, and therefore we are building the national evidence base for whether to detect market size and needs or whether to inform taxonomies, and we are not responding, but actually we are feeding data in the system so that they refine policies and regulations. There are a lot of other things, but I think these are the most important. So I believe that banks who put sustainability at the core, the strategic core, will be indispensable partners for national authorities to shape and deliver national outcomes and national agendas. So in short, we are advisors, we are conveners, we are market setters, we are implementers, we are shaping and delivering the outcomes with the governments and other national agendas to shape the future.
I love the fact that you're combining two key elements. One is advisory sort of services within the context of the projects. The other key word which will dovetail around on the course of the panel is the data. And trusted data, but also leveraging that in the context of advantage to move the needle forward. So some really critical insights there, and I think that's a really good platform to lead into the risk side and the insurance side. Nadia, on your side, obviously insurance companies, you're uniquely positioned on this front to balance risk and sort of look at how do you quantify and manage climate risk. So I guess from a Zurich perspective, in the work that you're doing, how are you integrating sustainability into the underwriting and sort of risk modeling aspect? Probably more so in the region, but happy to take a lens on a global level as well.
Yeah, thank you very much. So already recognized there are a lot of parallels between banking and insurance in terms of how we look at risk and how this has evolved. I mean, the insurance sector generally is not known to be innovators, very traditional sector. But I think this is really changing now. We're looking at climate risk assessments, so really looking at physical risk that is hyper-local, looking at asset-based risks and the physical risks that are influencing that. And in the past, insurance companies based their pricing a lot on historical data. That's no longer valid. So while we still use historical data, we now have to come up with new models. So we have a lot of risk engineers, climate scientists actually as well. You okay?
There's a risk there.
Physical risk. And they work together on modeling those risks and building them into our underwriting. So underwriting models are changing, the risk frameworks are changing and evolving based on what we perceive, but also going into like a predictive modeling direction, like how can we map this out into the future? And there are a lot of synergies that we can have with banks as well, looking at financing certain projects. How can insurance help bring in that data that we have? Anything related to risk, right? We can really be a great partner. Something else we focus on is sector-specific guidelines. So looking at energy sector, construction, transportation, where we build this into the underwriting, specific risks that can be mapped there. One that I'm very, very passionate about is an insurance solution called parametric insurance. It's becoming more and more popular. Parametric insurance is an insurance product that pays out based on certain triggers. So let's say it rains for an extended number of days, which there's a higher risk of a flood. Based on specific triggers that are set, the insurance pays out already. It's a preset amount, and that avoids having long claim processes.
What's it? How do you pronounce it?
Parametric.
Parametric. Okay, my Aussie accent there.
For the measurement, parametric. So, for example, I can give you an example for it's a lot used in agriculture, where, for example, when there are extended number of days of drought or rainfall, it pays out. And what it does, it helps people recover much faster and become more resilient. If you have a real loss and you have to go through a claims process that can take months, right, sometimes, there's a real impact to the business. With such solutions and immediate payouts that are pre-decided and predefined, it helps recover much faster and become more resilient. So this model can be applied to different sectors as well, to buildings and companies. And then we also collaborate with regulators, policymakers, cross-industry collaboration. I think it's really important to get to solutions that work for everyone. And this is really an area where we don't compete, where we benefit from collaboration within sustainability. And it helps with collaborating with regulators helps inform policy making, and we can also feed in data and experience that we have to help define those rules and regulations that come out, and as well as the taxonomies.
Brilliant. And again, you ended on a note of the data side, because I think that's the really core element in terms of how and where is that utilized and where you're obtaining it from, both internally but also in collaboration with strategic partners such as the banks, but also with the key research and index firms. So coming to you, Patil, on your side, what trends are you seeing in the capital markets as sustainability metrics become embedded in valuation and credit risk assessments, as Nadia sort of just outlined as well?
So some of the trends have already been mentioned by Suzan and Nadia, starting with the data and their standardization of data and the scenarios that are being used. So how we quantify the climate-related risks and opportunities that are forward-looking and what that are forward-looking. So one of the things that we see is the harmonization of the methodologies and the scenarios that are being used, such as the NGFS, for example. So for example, now the NGFS is being adopted by 130 central banks, covering 88% of the global greenhouse gas emissions and all the major banks. Also, the capital markets are adopting the PCAF, so more than exceeding 500 signatories. So PCAF really guides on what type of data to use, quality of data to use in the portfolio level, greenhouse gas baselining, so for the different asset classes and all that. And also we're seeing the ISSP standards are being adopted, so guiding the companies on what to disclose and what metrics to use in their climate-related financial disclosures. And talking about their transition plan. So that's one of the trends, so seeing data and scenario standardization and harmonization. The second trend, as mentioned by you, is the need for methodologies to become more industry-specific, asset-specific, location-specific, and backed by science. So data needs to be based on approaches that are reflective on the context, and what type of assets and operations that we're dealing with, so that concrete risk data is being used in the different risk frameworks. So global averages, global insights are no longer satisfactory. So there is a need to have that very granular data, whether it's at the transition level or physical risk level, and deep diving into what type of assets we're looking at. And lastly, I would say investors are looking beyond just the operations of the issuers, of the listed companies, or their overall exposures, and looking at the supply chain as well. Physical risk is one of the key disruptors of the businesses and the business operations. The S&P data has shown that in the Middle East, around 96% of the companies have at least one asset that is exposed to physical risk, and around 4.1% of the asset value is at risk, financial impact at risk from physical risk, and very low percentage, around 1 or 2% of the companies have resiliency plans and adaptation plans. So the investors are looking beyond just the company and are looking how well they're managing their supply chains, what is their strategy there, and how exposed they are to the risk, but also how well they're managing it. So, yeah.
That's brilliant. And I think, again, going back to the point of contextualization and context of the data, where it sits, looking at it on a local level within the supply chain, and then applying that appropriately relative to the risk modeling that's going on. I haven't used the word AI. I probably plan not to, because we're going to talk more about data. But at the same time, that's where the innovation comes in. And I think this is where, coming back to you, Suzan, from your sphere, when we're looking at those financial instruments, beyond green bonds, what are you seeing emerge in Egypt, in this area, regionally, globally, to accelerate the climate-aligned investment, and thinking about the innovation behind that?
Well, I think green bonds, they open the door for climate finance, but the landscape and the instruments have expanded much more than that. And Egypt and other emerging markets and other countries in the region, they need flexible and scalable instruments that matches their development needs and risk realities. And from beginning with one of the instruments that are really transformative is sustainability-linked loans and bonds. And they are transformative because they financially reward impact. Not unlike green bonds, which is ring-fenced to specific projects. This is much more related. Sustainability-linked loans or bonds are linked to specific KPIs. And for us at Banque Misr, we are proud that we have launched 4 months ago the first sustainability-linked loan in collaboration with EBRD to a financial institution, the first in Egypt and the MENA region. And it's linked to incentivized pricing that really is very much related to what Egypt needs, like women entrepreneurial lending, like social housing and green financing. So therefore, this kind of financing, which turns sustainability to a financial incentive, is really very powerful. The other is Islamic finance and sukuk, especially in these parts of the world. I think that Egypt and the GCC is a suitable terrain for such kind of financing, for resilient agriculture, water infrastructure, renewable energy, and others. Also, blended finance, of course, and risk sharing, as we've been discussing, is very important, because in these parts of the world and in emerging countries, if you want to scale up climate investment, then you must reduce risk. And guarantees and political risk insurance and other kinds of risks and physical risks are very important to attract much more investments for climate finance. The fifth is transition finance, and I think that this is very much needed, and it's a sleeping giant. Because especially in our parts of the world, also in the global south, we depend heavily on energy incentive sectors. And therefore, we cannot abandon these sectors or abandon financing these sectors, but we have to support them in their transition phase to shift from brown to green. Lastly, at Banque Misr, we launched an initiative called تقدر Go Accelerator, which is targeted for SMEs. And we realized that for the next generation of climate solutions is not only about finance, but also about capability. So this accelerator not only avails finance for these SMEs, but it converts their ideas to bankable projects. So we give them technical support, awareness, how not only on the technical part, but also on the marketing, financial parts, on how to scale their investments. So therefore, it's not only one instrument. I think in the future, it's a diversified menu of instruments and building a strong ecosystem to support the different risk levels, different policy priorities and development needs.
Yeah, I mean, the transition side that you mentioned there, that's really the gap. How do you bridge that gap, you know, from brown to green? And how do you encourage the transition, but also in a very sustainable way, where it doesn't disrupt services within sectors to be delivered? Ultimately, citizens, businesses require those services to be up and also to be delivered. And so you want to keep that going, but then have that slow transition plan along the pathway. And so that's a very critical element, and I think it's fantastic to see that you're seeing that, particularly in an emerging economy, because ultimately, you know, if I look at the emerging sort of nations, and I've been in this market for 19 years here in Dubai, but servicing across Middle East, Africa, and sort of Asia, the dynamic is very much around transition, whether it's transitioning an economy into a digital economy from old economy habits, whether it's looking at the future economy in terms of, you know, being more sustainable, much more aligned to the ESG mandates, but also looking at the assets that sit within that framework. A lot are sitting on assets which are not yet convertible. And so what you've got there is really an asset that's convertible, but it just needs to be realized through some kind of a transition finance plan. So I love that. Which leads into the, when we're talking about risk mitigation, incentivization. I know we had a great discussion off stage, by the way. We probably should have just recorded it and played it back for everybody here on the incentivization plan, but we'll kick it off on the insurance side. You know, beyond risk mitigation, you know, how can insurers actively incentivize businesses and individuals? I'll jump in later on the individual side, to adopt greener practices.
Yes, we had a great conversation there. We should have brought it here, but we'll touch upon it again. But before I answer your question, if I may, I'd like to add something to the transition part. I think it's very, very important to mention this, because there is this perception sometimes that we can just switch off oil tomorrow and everything is going to be green. That's not the reality. And I think we fare better by working together with our customers and clients and helping them get there, because also we need to ensure that energy remains affordable, right? So there are a lot of factors, particularly in emerging markets, that we need to take into consideration. I think that's really important. In terms of incentivizing, so what we do from an insurance perspective, very similar to what you mentioned, is around collaborating with our clients, working with them, advising them, helping them map out their risks, supply chain, value chain, very important. Everything is connected. Like, we need to realize that it's not just one company in one area. Many of them have supply chains and there's another impact. So we're looking at green premiums for companies that meet certain sustainability benchmarks, right? That display good behavior or have green buildings or whatever. Going to behavioral insurance, we touched upon this out there. So behavioral insurance can also be a great tool where we reward good behaviors. This could be in the mobility sector, this could be in the health sector. So looking at that, there may be a data privacy aspect that we also need to touch upon, but this can also be a way of incentivizing customers. Sustainable financing, so working with banks and investors and so on. Insurance can be a great partner in helping de-risk, particularly blended finance, and I feel like insurance is underutilized there because we can bring in all of this risk knowledge and help at an early stage when a project is being evaluated to bring in that risk angle and help and support to put financing together. And then going back to supplier chain engagement, what we also do is we work with our suppliers. So we have a supplier code of conduct, we engage with our suppliers, we talk to them about transition, and we have targets that we have set for the company that we want to achieve. And we eventually will only be able to work with suppliers that are aligned with our targets, meaning that have a net zero target, that are working towards that are transitioning. And we have to be honest that a lot of the suppliers are SMEs. They need support. We can't expect them to have a chief sustainability officer and they can just immediately implement everything. So what we as Zurich Insurance do is we make tools available to them for free that can help them map out their emissions and get started, some training material, particularly focused on SMEs to support them along the way. So these are some of the which are maybe not immediate monetary incentives, but incentives that we do where we support our clients as well as our suppliers and bring them along on this journey. I feel like sustainability is a very collaborative effort and we all have to work together, even cross-industry.
Yeah, it's definitely a collaborative effort. And I think you're right, when we're talking about the resourcing side, the SMEs, there is that expectation of having dedicated resources there to drive that agenda. Maybe the angle we should think about is fractionalized sharing of resources and offering them up in the ecosystem that you're in. And I think we underestimate that the resources do exist, but they're not necessarily being allowed to be made available for various reasons, KPIs and other reasons. So I think that's probably an element. When I go back onto the discussion on incentivization, and I always look at health in this world because you know, you look at a parallel industry and you say to yourself, is the incentivization happening at a level where the return on that investment is reciprocated? And so, you know, I do wear a device, probably a Whoop device out there for people who use one. And I look at it from this angle. It gives me data. And it gives me data in terms of my habits and what I do. So if you picture that angle of how I adapt my lifestyle towards the data, and it gives me an updated week-to-week, day-to-day, you know, essentially almost hour by hour stat of where I'm at. I obviously change my habits relative to that, but I also look at it from an angle, am I being incentivized through my ecosystem when I'm running a very healthy lifestyle? For example, maybe my pace of aging indicates I'm 5 or 10 years younger than my current age. So therefore, maybe the health insurance premiums should be relative to the data age that I have versus the biological age. And so if I start to use that mechanism and apply that to the world of insurance for sustainable practices and thinking about how do you incentivize, whether it's an individual, a home, a business, you're collecting the data. I make that data available today because I trust the platform that has taken the data and then making that a return to me relative to my information. So the incentivization drives behavior, therefore accelerates change. And so I'm a big believer in that world, and I think that's probably an angle that we collectively can look at more holistically on the sustainable side. So just some thoughts there, that's all.
Yeah, I think the behavioral aspect, I believe there's a lot of potential. Still, I think probably requires a little bit of time to really put this into practice. I know a lot of insurance companies are looking into this. One on the health side, also on the mobility side. So good driving behavior should also be rewarded, right? So looking at that, I think the challenge there is data privacy. So collecting the data can be done, but I think there also has to be comfort for individuals to know that their data is being used for the right purposes and not being shared with people that are not supposed to have them. I think that really needs to be guaranteed and protected. I think data privacy is a real important aspect when we talk about this. There's always this talk around data, but we also have to ensure we have a responsibility when we collect this data and process it, that we also protect it, right?
Totally agree, 100% agree. Privacy has to be at the key, and I think that's where that ecosystem of trust, keyword being trust, needs to be brought into the equation, which goes to S&P and Patil on your side, because you have access to a lot of this data across different verticals, but also the impact that it's providing, because you're attaining a lot of the ESG reporting in terms of when we're talking about sustainable practices. So standardized ESG reporting frameworks, they're bridging the gap between corporate disclosures and investor decision making. How is that happening? And how are you guys doing it? And more importantly, how can everybody else get involved?
The framework standardization is key and is a translation layer between the company's sustainability narrative and the financial decision making. So how can companies in a consistent manner communicate their transition plans, communicate their exposures, their risks, their opportunities in a way that the financial institutions, the financial sector can make informed decision making and benchmark one practice to another. So the standardization really help at 3 different levels. I would say one is to focus on the financial materiality of the risks and opportunities that companies are exposed to. Second is the consistency of the data and the methodologies that are being used. And third is making data more reliable to be used into the financial models, right? So let's start with the data standardization and the scenario standardization. So if we look at the ISSB S1 and S2, it really guides the companies on how to translate climate risk, physical risk, transition risk into financial metrics. And here, the methodology is also important. So the financial institutions would want to look at what scenarios were used, underlying data that were used, and what's the key metric, financial metric, as the key output. So for example, at S&P, what we do is that taking physical risk, and as an example, we take the IPCC, the shared socioeconomic pathway scenarios. So we use the 4 scenarios, we use a forward-looking approach, and we really try to translate at the hazard level the modeled average annual loss. So what is the financial impact, the dollar value that hazard will have on the asset value? And the same is done across the transition risk as well. So what is the policy risk, the cost of carbon associated, and then how it will impact the company's earnings and financials. So that's one. Standardization is important to really harmonize the financial metrics that will be used in the decision making. Second is the focus on the financial materiality or even the double materiality. So is it the social side, environmental, the governance side of things that really first enables the companies to prioritize the key topics that they have to focus on, prioritize, strategize, and also financially plan for it, but also enables the financial institutions to base their decisions on those financially key metrics. And lastly, it really makes the data more robust and reliable. It guides the companies on how to quantify it, how to disclose it, and it increases the investor trust. It increases the insurance, the banking segment, trust on what type of quality the companies are providing. And we're seeing more and more adoption of the ISSB standards globally. And even here, although it's still voluntary, but we're seeing increasing rate of ISSB adoption.
I love that. And I think you mentioned some of the key ones, which is around the economic value. I think that's always a key element of how do you measure the economic value and the economic return. The methodology of approach that you mentioned, ultimately a standardized approach is an important way to sort of move the needle and get people to move the needle within their organizations. So that's a really important angle. And then back to the data. The trusted data is, to me, it's almost like the fuel, ultimately. And we hear the story, data is the new oil. But in terms of this world, the trust of that data and how it's shared and where it's gone and who benefits through this sharing is, I think, a critical angle of approach. And maybe everyone here in the room should start thinking about what data they're currently sitting on, what data should they be calling upon, and how and what type of approach they can adopt in order to then scale innovation towards sustainable practices. And obviously, finance is one big element, but there's many ingredients within that element. So very important, and I think I love the fact that you guys are doing this across the board. And the fact that it's at a localized level, this is probably where the key opportunity lies, is that how do we bring everybody together? And I think we spoke off stage about this, the concept maybe of a sandbox that ends up providing some trusted ways where each stakeholder within that specific ecosystem can share, can collaborate, and then can utilize maybe a new solution or a new innovation to help accelerate that transition curve. So just some thoughts I wanted to put out there. We're about 5 minutes or 6 minutes now towards the end. And I did have a final question for everybody to sort of look into and answer. You can answer it, or you can hypothesize on something else. But I always like to answer it with a question that's thinking forward with the angle of what we're discussing, but also where you're seeing it from your own perspective in relation to the industry. And looking at where we are today, what's potentially, and again, I'll start probably with you, Suzan, on this one. What's one bold step we can take in the financial sector, or the financial sector should take, perhaps over the next 5 years, to truly make green finance a catalyst for sustainable growth? You know, what would that be? Just some thoughts.
Just coming back from Belém COP30, I believe the main message there was that it's beyond climate, and climate and nature are inseparable. So therefore, it's very important for biodiversity loss, the collapse of the ecosystem, nature-related risks are very much important as much as climate, and therefore they should be part of the financial risk assessments and credit decisioning and capital allocation. So the bold move for banks in the next 5 years would be to mainstream transition finance, integrating nature fully, and this to be supported by public de-risking and national taxonomies.
All right, love it.
I second
Nadia?
that, yes. Yeah, definitely support this. And also have region-specific solutions. What works in other countries may not be suitable for this region. We need to have regional focus. And also, I think for me, something really important is don't wait for it to be perfect. Don't wait for the environment, the regulatory environment, or the data to be perfect. Get started. Double materiality is a good place to start. Look at where your impacts are within your company. Get started. Anyway, it's a process of continuous improvement. This is an evolving space. Every year we're adding something onto it and we're evolving. Some people are waiting for the whole situation to be perfect for them to get started, or for the regulation to tell them to get started. I think for everybody, just get started somewhere, wherever you are, and you can build on that. And then also collaborate, cross-industry. Your bank, your insurance company can be a great partner. Companies that provide data can be great partners. Have conversations with them. For me, that's where we can really move the needle.
Excellent.
I would agree. I would say collaboration between the different players as data providers, insurance, the banking industry is key. I would also say to look beyond the short-term implications of climate, because climate is longer term, and the short-term return on investment might not be as favorable as other, non-climate friendly technologies initiatives. So to widen, the view and the horizon, and to look beyond the short-term consequences, because if you look at the longer-term numbers, it is backed by science and by global studies that climate change will be impacting the GDPs. So yeah.
Awesome, and I love all of those approaches, and again, thinking outside the box of what's possible. Maybe one thought from my perspective would be, if we're interested in our own pace of aging, maybe we've got to think about the Earth's pace of aging, and thinking about all of the metrics that come in relating to that, because ultimately that's where we live. And so, if we're doing it for ourselves, we've got to think about that angle. And I think all of the dynamics is collaboration. All the dynamics is around trusted data in an environment where there is a value for each of the stakeholders that participate. And I think when we start to look at that world in a much more collaborative way, things open up. And so, love the discussion. And I'd like to, look, I'm always ahead of time, look at that, got about a minute to go. But I think for us, it's just setting a stage for what's possible. And when you think about the world of green finance, it's all about what can we do individually, as an SME, as a corporate, as a government, as a regulation entity, and also on a global level, to be able to achieve the outcomes that we're trying to achieve here. So on that note, thank you to the panelists for a tremendous dialogue, and I hope there's a lot of value out of that. I'm pretty sure there is on every level. And thank you for the audience for being here. Have a great event.